The war against inflation. The persistent nature of inflation defied initial expectations of a temporary phase, leading to heightened anticipation of prolonged inflation among investors. Federal Reserve Chair Jerome Powell acknowledged the miscalculation in a Senate hearing, noting the rise in inflation expectations based on bond market fluctuations. By mid-November 2021, the 5-year inflation expectation surpassed 3%, indicating a sustained rise in anticipated inflation. This sentiment was further solidified as the 10-year expectation neared 3% by April 2022, showcasing a marked shift from earlier market beliefs. Chronic inflation became a pressing issue as inflation rates surged, peaking in June 2022 with CPI inflation at 9.1% and PCE inflation at 6.98%. This inflation was not merely high but driven by substantial wage growth, indicative of structural inflation. In such a scenario, rising prices and wages mutually reinforce each other, creating a cycle of persistent inflation. The rigidity of wages, which rarely decrease, further entrenches this inflationary cycle. The U.S. labor market saw significant shifts post-COVID-19. Despite the initial mass job losses, labor force participation didn't fully recover, remaining below pre-pandemic levels even by the end of 2022. This shortage led to recruitment challenges for companies, pushing up wages. The societal and cultural shift known as the Great Resignation saw many individuals leaving the workforce or changing jobs, further contributing to the labor shortage and wage increases. These factors collectively fueled sustained structural inflation. Despite the decrease in the savings rate to 2.7% by June 2022, the robust consumption growth fueled by stimulus and accumulated savings continued to exert upward pressure on inflation. Supply-side constraints, including persistent global supply chain disruptions and dampened business investment, exacerbated the inflationary pressure. International oil prices, a significant driver of U.S. inflation, also saw a notable rise during the period, fueled by increased demand, slow response from shut-in oil wells, and geopolitical tensions, particularly the military escalation in Ukraine. These combined factors maintained upward pressure on prices, challenging the initial belief that inflation would be a short-lived consequence of the post-pandemic recovery. Battle. In April 2021, Federal Reserve Chairman Jerome Powell expressed reluctance to taper the Fed's quantitative easing policy amid an uneven economic recovery. However, as inflation persisted, Powell's stance evolved, and by August, he signaled a possible tapering if the economy continued to improve. Following the September FOMC meeting, the Fed announced that tapering would begin in November, reducing monthly purchases of government bonds and mortgage-backed securities by $15 billion, aiming to conclude quantitative easing by March 2022. Despite fears of a taper tantrum similar to 2013, the 2021 tapering announcement led to only minor market adjustments, and the S&P 500 even reached a record high in January 2022. This relatively smooth market reaction was attributed to the Federal Reserve's clear communication strategy and its emphasis on maintaining an easing stance. As inflation hit 7.9% in March 2022, the Federal Reserve responded with a series of aggressive interest rate hikes, starting with a 0.25% increase and moving to larger increments in subsequent FOMC meetings. By July 2023, the benchmark interest rate range was 5.25 to 5.50%, marking the highest rate since the early 1980s. This series of hikes was an assertive action to address the highest inflation rates in decades. The Federal Reserve utilized forward guidance to mitigate market shocks associated with these rate hikes. By preemptively signaling impending austerity measures, they influenced investor behavior and aligned market expectations with policy objectives. This careful communication strategy, including the use of the dot plot to signal future rate changes, helped stabilize market reactions. In May 2022, the Fed embarked on quantitative tightening, QT, aiming to shrink its $9 trillion balance sheet by letting maturing bonds lapse and selectively selling to manage shortages. This was a shift from expanding to contracting its balance sheet. primarily affecting long-term government bonds. Despite the Federal Reserve's aggressive measures, the 10-year Treasury bond rate began to decline by mid-June 2022 due to concerns about economic growth. The market rates responded more to growth concerns than to the tightening monetary policy, leading to an inverted yield curve where long-term rates fell below short-term rates. Amid high interest rates and ongoing inflation, fears of a prolonged recession emerged, sparking debates about the economy's trajectory and whether it would achieve a soft or hard landing. The Federal Reserve continued its rate hikes to balance demand with constricted supply and prevent entrenched inflation, prioritizing long-term sustainable growth over short-term economic stimulation. By August 2022, the effects of the Federal Reserve's monetary policy began to manifest in the market, with both short and long-term rates rising. Despite negative growth rates in the first 2 quarters of 2022 and ongoing weak growth projections, the upward trend in market rates persisted until the end of 2022, indicating the market's adjustment to the Federal Reserve's tightening measures. The dollar's value exhibited strength amid rising interest rates, and the stock market entered a downward trend after peaking in early January 2022. The real economy, however, showed resilience with strong consumer spending and a robust job market. Positive news on consumption or employment often led to stock market concerns about prolonged tightening, complicating efforts to control inflation. With high interest rates impacting financial markets and the real economy not cooling sufficiently, experts anticipated a recession in 2023,